I really love that line from the original Men in Black movie. It's one of those things that just kind of sneaks up on you. You don't think about it that much, but when you reflect back on it, it's 100% true. An individual person is smart. People, as a group, are dumb. Prior post, I talk about this concept of confirmation bias, where you're only going to read stories that confirm what you already believe. We also have this feeling of recency bias. In other words, what's ever happened in the past will continue to happen. So let's take a look at what happened to the stock market and the bond market over the past 20 years and 10 years. And maybe we can figure out a little bit how not to make the same mistakes over and over again. You can see here that back in 2001, our intrepid investor, and let's assume they put $1 million to work, in a 50-50 portfolio, probably looking to make roughly 6%. Let's assume stocks are going to average 8% over long term. Bonds should average probably about half, although they've had periods where they've outperformed, obviously. Add the two together, divide by 2, 50-50, you get 6%. Well, then things start to move around a little bit. We can see here that we see some movement in '06. By 2011, they were pretty back to even. But following the crash of '08, we saw extremely low interest rates. Now, they did two things. It caused the bond market to way overperform for a number of years, but at the same time, it really added a lot of liquidity to the equity market. So the average investor that wasn't paying attention was about 65-35. By the time they got to the end of 2021, they were 76-24 or even greater. So the first question I would ask if you're an investor, if it were 20 years later and you had 20 years less to work and you were 20 years closer to whatever you needed the money for, and assuming that money was in cash, would you invest it 76% in the equity market at the end of 2021? The answer, logically, is probably not. It probably wouldn't be appropriate, because if you started at 50-50, which is kind of a growth and income approach, why would you be into an aggressive growth approach by the time you get to 2021? Well, you wouldn't be, but that's where the market took you. The market puts you in that aggressive posture, and hey, let's leave well enough alone. Everything's going great. Why should we screw around with it? We'll just leave it as it is. Except for this. One of the things that most people fail to see is, as the equity markets are rising, it doesn't mean there's less risk. It actually means the further they gravitate away from the long-term average annual return, the higher the probability is something bad can happen. Then you run into something called the mathematics of loss, and it just gets to be a real big mess. So here's our so-called riskless transaction, 100% bonds, not much of a rate of return. It's all relative over here. But we look at our risk line or standard deviation. Now, if we move up and start to buy some stocks, 68% bonds, 32% equities, we can actually see our green line, our return line goes up, our red line goes back. At 50-50, look what happens. Green line still goes up, red line gets a little bigger than the prior line, but it's still better than being all bonds. And then when you get right around here, that's where you're going to get the most bang for your buck, is right around this 60-40 area. You can see that we've got a good solid long-term return. We have a volatility which is probably equal, maybe even less than 100% bonds. But watch what happens as the asset allocation just takes itself over. And what I'd like you to do is pay attention to the difference in the line from here to here. That's your return line, going from maybe 10.5 up to maybe 11.75. But look at what's happening to your risk line. This line is about twice as long as this. So to pick up a little bit of incremental return, we're picking up a bucket load of risk. And at the same token, here's what happens out here when you go to 100% equities. As your portfolio becomes overweighted in equities, you got to do something. You can't just sit there and stare. I always believed in rebalancing back to your original allocation once you get too far away. But let's just run the numbers, because it was pretty compelling to do anything but. Original target rate of return, 6% overall. Let's just look at our equity position for a second. Starting value back here of $500,000. Wow, 2021. That's some cool stuff. Up to 2.28 million, assuming you were in the S&P and you just stayed put. So there's your 2.28, and then around mid-year, had a bit of a punch in the nose. Market declined over 20%. You're down $512,000. You're down 22.5%. Now, you're not going to make it up with a 22.5% return. You need almost 29% to make it up. So you've got to ask yourself, what's the likelihood I'm going to see a 29% annual return after coming off performance over the past 3 years that looks like this? Is the likelihood it's going to gravitate back to the mean? Or is the likelihood instead it's going to just keep outperforming and set up a new standard mean? Well, the answer is pretty simple. As a person, you would make a decision that a 50-50 allocation would get you where you needed to go, and you would rebalance back to that allocation with your advisor. If, however, you said when your advisor called to rebalance, well, let's just leave well enough alone, and your advisor agreed with you, you need a new advisor. Because you didn't hire your advisor to make the maximum return on your money. You hired your advisor to get you to a goal. If that goal was satisfied by 6%, you could have walked across the finish line with great ease by actually dialing back the aggressiveness of your investments. You still got time because you've still overperformed, even looking back at what's happened in the past. Bottom line is that risk of loss increases as the market gets further and further away from its long-term averages. Second, the mathematics of loss means if you lose 50% of your money, getting 50% back doesn't get you back where you want. You got to get to 100. Guys, they're just numbers. Pay attention to your goals. Pay attention to what you really want to accomplish. Stop reading everything that makes you feel like your latest, greatest decision was the best, and you'll get where you need to go. Thanks for your time.